Bullish Bearish Mindset: The Guide to Becoming a Disciplined, Patient, and Successful Trader. Copyright 2022 Anthony Jones. All rights reserved. Dedication. Purpose: This book is a combination of valuable lessons and notes that I have learned over time from my experiences in trading these volatile markets. Knowledge is powerful and will help as great assistance in trading today's markets. In this book I go into details of important trading lessons from winning and losing trades. These are notes that I have recorded and put together as a guide to information shared from past mistakes that have made me into the better trader I am today. I do not want other traders to make the same mistakes from not having proper risk management skills, not being disciplined and patient. This book will help guide your mindset to a more prosperous, successful mind state of awareness for technical analysis, candlestick recognition, intraday setups, fundamental and technical analysis, trending market strategies and risk management for stocks, crypto, options or futures trading to produce and maintain better results. Contents: Introduction 1. Have a plan. pg 2. Set and follow rules. 14.3 Psychological mindset. XXX 4 Risk management. 44.5 Analyzing trades. I6 Patience is key. I7 Self-awareness. IXV 8 Trade strategy. 77 9 Law of propensity. 86 10 Definitions. 94 Introduction. Day trading can make you wealthy and can also make you broke if you allow it to. Losing trades can and will make you unconsciously do unpredictable things depending on your mindset at the time. I have a motivational, determined attitude for success, therefore I remained consistent and I never gave up. This can be both positive in trading or it could also make out for bad decisions at times. Throughout my trading journey I have lost large amounts of money, and what makes it even worse, it was not from gains in the market but from actually life savings from working hard. This also had caused me to revenge trade, which was my biggest mistake. As I look back, the lessons were valuable, but at times I wish if only I could have read a book like this and actually applied the knowledge to my trading. It would have saved me a lot of money as well as mental stress. I went through a lot mentally, but in the end it has made me a better trader. Everything happens for a reason, and I was blessed enough to be able to bounce back and recover from big losses even when it felt like I was at rock bottom, considering my monthly bills as well as the debt that I had gotten myself into. Some of the rules and strategies that I have put together in this book can also be found anywhere, but they only work if you actually apply them. It's one thing to say you will change habits and do something, and another to actually do it. Successful trading mostly boils down to your psychology and technical analysis combined to obtain and maintain better results. 1. Have a plan. Have a plan for both entry and exit and identify ranges and key levels. Always check for volume before entry on trade. More vol than average equals better confirmation. Less vol than average equals lower confirmation. Look at the year chart for support. Look at 5-day chart for resistance before you enter any trade. You must have a predetermined plan and a solid trade thesis. 1. Conditions. 2. Time frames. 3. Targets and stop losses. 4. Position size. 5. Managing the trade. Follow your plan. Trust your process. Do not let your emotions do the trading. Let the chart do it. Patience plus strategy equals gratification. Trade the trend before you enter any trade. You must know the type of trade you are looking to put on. 1. Scalp. Shorter term price movement. Quick intraday move. Fast entries and even faster exits. 2. Trend trade. Day trade. Holding for a bullish or bearish trend. Longer than a scalp, as you are capitalizing on a larger range move. There are only 2 ways I sell a position. 1. If my target hits. 2. If my stop loss triggers. Everything else in between is noise. The market isn't going to move straight in your favor all the time. Pullbacks, bounces, and consolidations are completely normal. They should not freak you out. This means you are focusing too much on the dollar sign and letting emotions get involved. Mark price levels on the chart. Pre-market high, pre-market low, previous day high, and low on the 5 or 15-minute time frame. Stop being afraid to take a losing trade. Trading out of fear means we are too focused on the risk, and are unlikely to capitalize on the full reward. How to avoid the fear of losing. 1. Have a trading strategy plan that's proven to work consistently in the long run. Supply demand. 2. Remove the guessing out of your trading ego. Market. 3. Change your mind state. You have to lose in order to win. 4. Focus on 3. 1. Risk reward. Losing trades don't matter. 5. Give the trade more room to breathe. Larger position size equals tighter stop loss. Smaller position size equals wider stop loss. The trend is your friend at that moment. Momentum play of the day. Trade the chart. Focus on setup. If it's choppy, exit. You can always Enter at a better price only. Write up of strong green candles on the 5-minute. Stick to high probability setups. Good fundamentals. Catalyst. Relative strength. Market cap. High conviction. Social trends. News. Catalyst. Oversold at 2 weeks. Support tends to rally back up. Overbought at resistance tends to fall back down. If a ticker does not have momentum, it may consolidate and trade in a range or light Fibonacci. Retracement channel. Adapt to markets. Every 2 to 3 days will be a different hot or cold sector. Before trading, ask yourself, is my mindset mind state good to trade now? Manage uncertainty. The outcome cannot be controlled. Always trade what you see and not what you think. To become a long-term consistently profitable trader, you must train your brain to acquire the mental skills you will need. Stay focused on the process of trading and not the results or consequences. Trading outcomes are unique and random, never the same. And consistent returns can be maintained over time in the market with an edge over a series of trades. Rome was not built in one day. Be patient and consistent. Think in probabilities. Do not have expectations. Avoid mental pain, i.e. disappointments and feeling betrayed, which will cause you to misinterpret market action and can disable you from entering winning trades or not be able to exit a losing trade. Trading is not about being right or wrong. Especially in this kangaroo market, you can be both right and wrong at the same time. It is the odds of other buyers coming in and bidding higher than the price you brought at, or if more sellers will come in and offer to sell lower than you sold. Have a probability mindset. Be a sniper and not a machine gunner. Have the discipline of a ruler. The courage of a warrior. Be comfortable. Self-soothing plus morning meditation is a good start to trading. Focus on performance and not outcome. Be attentive in the moment. Do not be hypnotized. Pay attention. Think. Do not be indecisive. Process the brain for emotional enrichment and symbolic mind representation to retain the mind for managing challenges of uncertainty. Build the mind that thinks in the moment of performance. I am not my thoughts. Convert the brain from surviving by fear and aggression, FUD, to engaging uncertainty with a probability mindset. Get comfortable being uncomfortable. Tier trade in and out. First strike with low sizes. Trade shows strength. Scale in as hit targets. Take profit and tier out to lock in gains. Plus I will cut losers quickly and have no hope in a stock if showing weakness and fails to hold support, especially if the SPY is failing red. Exit the last 30 minutes to the bell shows the stock's true strength, i.e. if stock opens strong and closes weak. Vice versa, in a bull market stock will close strong above 200-day moving average is bullish, below is bearish. Do not have hopium, only conviction. Setups. Study chart and setups for plan before open and during the session. Check sectors performances. Volume. RSI is more effective on the 4-hour. Zoom out and look left to verify the trade. Use extended after hours to see support and resistance only. Trade large volume stocks, less likely to be manipulated. If you are long, call on overbought RSI as soon as hit 50 line from 80. Sell call if short put oversold as soon as it comes back to 40. Sell put. Set target alerts on Trading View for support or resistance and most volume on volume profile. Follow Google Trends for stocks momentum and interest before entering trade. Look at timing rates, inflation, economy, yields on bonds, supply chain, dollar, tapper, news. Macroeconomic conditions to market. 1. The world. What's going on? Micro. 2. Fundamentals on company. 3. Thesis. Why am I doing trade? 4. What would stop me out? 5. How do I take the trade? Offer 4 different ways to execute strategy. At the opening bell, watch key levels, pre-market highs and lows, previous day's last high and low. Pay attention to the first volume bars, volume for strength or weakness. Check if RSI is overbought or oversold. Is MACD trending green or red? Watch to see if pre-market low or high holds or breaks. These are all key factors in determining a trend for the day's price action. Can help for a quick in and out scalp, or with the strong trend can be a day trade. Unusually after 3.5 to 4 points on the SPY and QQQ, the trend may reverse or have a significant pullback or pop up to VWAP. May want to take profits at those psychological zone areas. Can ride trend if going up or down, riding the 5 or 7 moving average, and of course over VWAP tends to be bullish and under VWAP tends to be bearish. Watch for key support or major resistance levels on the daily chart. 4 hours, 1 hour, 15 minutes for bounce, reject or breakout. Remember to take profits when the market is overnighted on a big breakout or breakdown. Trim some, especially if your gut is telling you here is my target. Take some off table, let other winners run or lose value. That way you already secured some of your bag. Protect profits, set stop loss. It's imperative to do that in this market or have a solid exit strategy. Cut losers quickly. It does not make sense to hold losers to zero. We must protect our capital by all means. One thing I noticed about myself is I always average down on losing trades. The more it went against me, the more I averaged down. In some situations that may help your trade by managing the trade so when and if you get a reversal to your side, it will accumulate the gains to be able to break even. Turning a losing trade into a winning trade and sometimes turn it into a big winning trade, but that strategy I have learned from experience is risky, and even when you get back in profit your mind will be released from recovering losses, making you want to take profits and exit the position. But at the end of the day it all depends on the market environment fundamentally and technicals of that day. Some people average up on winning trades that can be profitable also. It's all dependent on the momentum of that time to upside bullish sentiment or downside bearish sentiment. Follow the trend until it bends. Know your buy-sell levels in advance. Using limit orders will translate into a better execution, and it will also help you avoid making trades based on emotions. The solution to stop forcing trades and to be more disciplined and patient: use limit orders instead of market orders. You don't force trades. You let the market come to you. Making money is an action. Keeping money is a behavior, and growing money is knowledge. Two-step process for entering trades. Play levels. Identify and create levels of interest. Key levels or supply and demand. React to the market at your levels of interest. Spot buyers and sellers at your levels of interest. Take reading related markets, volume chart, etc. Without either of the two coming together we do not have a trade. Have a plan and know targets, when to get in and when to get out. Have a system. If does not work, modify it, or exit. Re-enter or find a better trade. BDBR: buy dip or buy rip on a stock that has been consolidating. Wait for confirmation. If it does not meet my criteria, do not risk your capital. Only high quality setups. Oversold on 4-hour. Expect a rebounding leg up. Overextended on short-term 30 minutes day chart. Expect a pullback. Always check different time zones on the chart for outlook. Watch for overnight gap fills. Watch for bull flag or bear flag for reversal entry. Use the futures chart to track the SPY. Ask yourself, is this trade in line with my risk management guidelines? Is this trade in line with my trade plan? Do I know where my entry trigger should be? Do I know where to exit the trade if I am wrong? Are the fundamentals on my side of the trade? Do I have an in-trade management plan? Do I feel 100% confident with the trade I am about to take? For beginners, I recommend starting off trading shares instead of jumping into options. Are risky but have more potential for higher reward. Or practice with paper trading. 2. Set and follow rules. Trading rules system must be designed for big wins and small losses too. Your trading system must be built on quantifying able facts, not opinions. 3. Look for low risk, high reward probability setups. 4. Answer the question, what is this trend? Is the question, what is the time frame? 5. Start with a weekly chart to establish the long-term trend and then work down to daily and hourly charts to trade in the direction of trend. The odds are better if you are trading in the direction of long-term trend. 6. The more times the support or resistance levels are tested, the theater the odds it will be broken, i.e. 3 to 4 times. Usually old resistance can become new support and old support becomes new resistance. 7. Moving averages can quantify trends. I create signals for entries, exits and trailing stops. 8. Bull markets have no long-term resistance and bear markets have no long-term support. 9. The larger the market gaps, the greater the odds for a continuation. 10. The last hour often tells the truth about how strong a trend truly is. Smart money shows its hand in the last hour to trap short or to trap longs. They're having consecutive strong closes. Look for an continued uptrend may be likely to happen, but it may end when there is a morning rally up followed by a weak close. 11. Above the 200-day EMA is bullish for uptrends and downtrends happen below the 200-day moving average. 12. It's much easier to watch a few stocks than many. 13. First sharp dip always finds buyers and first big rip always finds sellers. Reversals build slowly. 14. Successful trading is about doing the difficult thing so often that it becomes second nature. 15. The best trades almost work right away, because if you plan, the reward will shower in charts. Price action. 16. Wishful thinking must be banished. Hope is not a trading plan, not a strategy for trading. Be ready to go, have funds ready for the opportunity to increase. Look far left on chart for key levels. 8. Look down all the way, check MACD then RSI for confirmation. The higher the market cap, the easier for stock. 70. Go up strong and the lower the float, the easier with more volume to squeeze up. When volume fades, price fades. Look for gap close reversals. Set price alert a bit before target to allow time for entry, but has to have volume inflow. VPVR red midline is a strong indicator of support or resistance. Most volume traded A new strategy start with one contract on super trend buy or short when CCI trend says long add contracts momentum Chanel indicators use one mine for scalp same day 15 minutes for long day, 4 hours or day chart for weekly swings. Identify and mark key levels on the chart for later reference opening price, yesterday's high or low, pre-market high, pre-market low, watch psychological levels x2, 40. 72 Always look at 2 levels for support on Fibonacci retracement channel. Always check vol and open interest before entering trade. Be patient and wait for the best setup and tear into the trade. Make this promise to yourself. Holding and hoping is stupid and I promise from now on I will not do it. If the trend fails and breaks support I will exit the position ASAP. We will not lose more hard-earned money. Will wait for confirmation and tear in. Always check volume before enter. Check BART chart. Volume leader price and vol advances. If not listed do not trade for long or short trade. NT sometimes no trade is the best trade. Doing nothing in the market and analyzing and waiting for a proper setup is doing best for the best overall outcome. Sell at your target's law of propensity. Small gains add up, and slow advancing compound interest is the best safest way to trade the markets. This strategy requires patience and time but will pay out nicely over time. Take more smaller profits. 15 to 20% equals safer. Better to take 10% gain than 80% loss. Tickers are much easier to fail than go up depending on the market sentiment. Small profits. Compounding interest adds up over time is the only real way to become constantly profitable. Just like the casino, they take big losses and big gains sometimes but it's all random, but they do have a set algorithm for profit quota. They are guaranteed to make 1.7% of total money every day, which can be over 8 million a year. Become the casino instead of the gambler and make compounding smaller gains over time that will add up to amounts that you will be able to live the life that you deserve and is destined for your hard work and effort. And since most options usually expire worthless, best to sell premium and collect risks income. Pay attention to price action and volume. Look left on 15 and 5 minutes. Use Apple as a gauge to take profits on QQQ or SPY at resistance. You have to be active in this market, especially on a Friday 0DE. Everything after 3 is mostly worthless. 10-minute rig can be profitable into after hours with heavy volume if you are up to 150% to 300% on a Friday most. It likely means it's time to take profit before reversal. 2.5 to 5-point move rule up and down on SPY. Set sell limits. Liquidation. If a heavy bearish day into close will tank lower after pop. If a heavy bullish day into the close will rise higher after the drop with good momentum but still should manage trade and take profits on the best bid limit price. NT no trigger no trade. Trade the chart lines, not the headlines. When consolidates in a channel for more than 6 days means it's getting ready to break out in a big move in the direction of sentiment movement, bullish up or bearish down. If your option contract is not in the money on 0-day expiration towards close, do not hold into close. Will be worthless if momentum is not in the trade direction. If a call or put goes up 120% out of the money on a Friday, take profit ASAP before fast reversal. End of the day will be worthless. On a Friday, market makers typically run it up the first 30 minutes of trading at open to manipulate puts and kill put premiums. Also bull trap so their sell orders can get filled on the rug pull. Watch the bid for previous day's high resistance or low support. Manage premium and take what you can get if going against the trend and get 90 to 100% on SPX. Quickly take profit which may be at VWAP before reversal. Look at open interest, go where the money is at. Watch consolidation for a breakout in the direction of movement over VWAP or under VWAP. Trading is about protecting what you can lose, not what you can gain. The last 15 minutes of trading can do in the money. SPX in direction of momentum. YOLO with a low amount. Sometimes being in a bad trade turns out to be a profitable trade, and sometimes being in a good trade can turn out to be a losing trade because the market sometimes has the opposite reaction. For example, buy the rumor, sell the news. Example, earnings on a stock may fail but the stock may still go up because it's already priced in for a miss, and the company may give good guidance, or a stock may beat earnings and the stock might tank because they gave bad guidance. It all depends on market sentiment at the time and where the microeconomy is. Pay attention to the daily chart will tell the story as it unfolds. Sometimes in trading I look back and see it was telling the whole time. Just look left for major support and resistance in the day chart. When everyone is over bullish may be a time to be bearish, and when everyone is over bearish may be a time to be bullish. Just have patience and give your trades time and manage accordingly. After FOMC Fed meetings will have a big movement in markets to fill in the missing information pieces of the puzzle for confirmation continuation to an uptrend or downtrend in markets. Markets do not like uncertainty, but I guess if there was no uncertainty there would not be as much of a volatile market. Profitable smart trading is about risk management. Use smaller amounts to make bigger profits. Risk $1 to make $3-4 instead of risking $4 to make 8. Compound interests add up, and if you stay consistent and profitable you will be able to survive to make big gains over time. It's good to meditate before trading. It's imperative to have a positive, clear thinking mind when and before taking a trade, to be mindful and analyze the chart and momentum for a high probability setup. Do not overthink in trading or try to take the perfect entry or exit because the trade will go in the direction you anticipated without you. Do not try to rush a trade. Instead of chasing a trade, let the market come to you. Use limit orders instead of market orders. In a bull market, old resistance can become new support, and in a bear market direction, old support can become new resistance. On a big gap down day, have the option can already be opened at open to get the lowest cents price for options call as soon as hit gap fill or close to it to sell. Apple 165 strike price on Friday opened at 5.10 cents. Within 35 minutes from opening bell the contracts hit 1.25 when Apple went green, then retracted back forward to 30 cents. That's 1,200% in less than an hour. Do not force a trade or have FOMO. If you miss entry there will be another entry trade at better price. Know that. Remember that. Pay attention to pre-market price action. If a stock is weak or strong, breaking down or out for relative strength compared to other tickers, it is imperative, very important, to cut losing trade if come back to break-even price. Exit trade especially if down 20%. Pay attention to Bitcoin spike ups or gap downs for relative market action. Always put on a hedge trade when uncertain on big gaps. On a gap down, look for previous day's support to become resistance. Buy options at the break-even price for target. Look left for the support target. Smart money takes profit at resistance or support targets. Negative first red candle sell. The markets are greedy. The best comfort zone in this bear market is to have all positions closed by end of day and liquidity ready for studied next day. Best opportunity. You can buy into strength the same way you buy into weakness, vice versa. You can short into weakness on a strong downtrend. Entry does not have to be perfect to ride the momentum trend until the reverse. As long as under VWAP you can hold puts. On a strong downtrend, same as over VWAP. On a strong uptrend with volume, watch volume will tell the strength. Watch for overreaction to upside or downside for next day reversal. Never have too much conviction. If you are uncertain, play both sides, call and put. Always pause and think before entering trade. Does it make practical sense when stocks have been rallying too much, overreacting, or falling too much? Overreaction, it may be coming up for a reversal. Learn to use stop loss and apply it every day to protect assets. Have no bias. Every day is unique. If the volume is low on your side of the trade, exit the trade and re-enter. Always take a small position tester. Before risking your decided investment, obtain at least 4 or 5 positive confirmations before taking a position. Start with one stock and master it before venturing out into other stocks. Only trade companies with a catalyst so you will have reason for the movement. Paper trade first and make your mistakes with fake money. Control your emotions and fears. You cannot predict the market. No one can. Don't be greedy. Take what the market gives you. Don't trade with the money that you need. Only trade with up to 5% of what your account balance is. New traders should only start with 1%. Do not overtrade. Overtrading is very dangerous, especially after a big gain or big loss. These rules are easily said, but I have to actually follow them and not procrastinate. I have lost a lot, made some back, and said I would have good risk management, then the following day lost most of it. By not being disciplined in following my rules, I have to apply them. I cannot predict the market. All I can do is be patient, wait for confirmation, and play the chart. Don't let your mind play tricks on you. Buying volume may come in after candles establish a base over VWAP and hold over after retesting the wick off VWAP. Continue to follow your plan. Do not steer away. Be disciplined and take profit at target. Most of the time it's best not to trade the market open and wait for patterns and good setups to form. Wait until the premium is cheaper. I am making a commitment to be disciplined and trade exactly to the rules. I will make it a priority and habit like second nature and respond mechanically and automatically. Make up your mind to have a desire and skills to trade the markets based on strategy and goals rather than the outcome and money. Have a mechanical robotic system, entries and exits. Less judgment and guessing. Trying to extract money from the markets fast is usually a setup for failure and is the wrong approach, but with time and patience, smaller gains in the market tend to be a key for success. Reasons why beginning trader fails. They are unable to cut losses and hold losers with hope. They think trading is a get-rich-quick. They try to overtrade to make a profit, chase plays on FOMO or misplays from being scared of entering. They don't have a plan and gamble their money if price volume and your gut is telling you your trade is invalidated. Exit the trade and reassess. Reevaluate the next high probability setup. Patience or forbearance is the ability to endure difficult circumstances. Patience may involve perseverance in the face of delay, tolerance of provocation without responding in disrespect, anger, or forbearance when under strain, especially when faced with longer-term difficulties, or being able to wait for a long amount of time without getting irritated or bored. Patience is the level of endurance one can have before disrespect. It is also used to refer to the character trait of being steadfast. Antonyms include hastiness and impetuousness. 3. Psychological mindset. Trading psychology. 1. Know your strengths. 2. Develop confidence. 3. Know your weaknesses. 4. Know when to take a break. 5. Become self-aware. 6. Learn to change. 7. Control your environment. 8. Deal with stress. 9. Pinpoint your emotions. 10. Develop a routine. 11. Challenge your ideals. Never think you know what the market will do. Start with a positive winning attitude. Only react and do not try to predict. Ride the wave of what the market will give you that day. Have no bias. Remain objective. Know when the market does a certain move and you see a certain pattern, you will know how to execute. You cannot control the market, but you can control your emotions and actions. Markets have different favored stocks every other week or so. Must have discipline. The practice of training people to obey rules or a code of behavior. Using punishment to correct disobedience. You must trust yourself to be objective in making decisions, to act in your own best interest. Follow the rules for success. We make decisions every day, and our daily decisions compound and create our future. If you don't have discipline, you're not in control of your decisions. You're controlled by your moods and emotions, which leads to poor decision making. Focus and live in the present moment. Focus on the present moment. Being in the present moment is where you will have the greatest control, where you will feel the most at ease, and where happiness flourishes. There is a super tight connection between happiness and the ability to live in the present moment. Staying present is the skill of having your mind in the moment, not in the past, not in the future, but right here. Stay consistent. Life is a journey. Success is not a one-time action but a continuous process. There is no time to mourn over your failures because this wastes time, but just pick yourself up and keep moving on. Success is not a destination, but a process of consistency is a journey. Self-reckoning, fear and big gains. Euphoria can be the biggest risk in trading. Stay humble and open-minded at all times. A win too big can make you trade with too much size and not have proper risk management, and a big loss can make you imperative and disabled, not able to enter a winning trade when the odds are in your favor. I believe in uncertainty. Which direction will the market go today? I do not know, but I can put on a good probability trade in the direction of the momentum trend on the day or 4-hour chart. 30-minute/15 minute 5 minutes. That will make sense if the odds are in my favor. Be strict in rules and flexible in expectations. Observe yourself when trading and monitor decisions. Treat trading as your business and you are the CEO. If you trade poorly or good, you will be at full responsibility for the outcome of your trading, profit and loss on the day. So be an overseer of your own decisions. Then analyze and act. Pay attention to your thoughts. If you seem to feel hopeful in a losing or winning trade and seem to be immobilized, automatically activate your higher, smarter, radical self to act in the moment. Set sell limit if not sure of the outcome, to take profit of what the market is offering at the moment. Do not be addicted to random rewards. Domination motivation. I am a consistent profitable trader. I am a constantly profitable trader. I have a winning attitude and I maintain a humble, attentive, observing mindset. Think into existence. Have the power to trade like a robot when the trend changes, long from short or short from long. Switch trend and go the other direction. Align mental environment with the flow of the market. Be in sync. Align mental environment. The fundamental truths. 1. Build the self-trust necessary to operate in an unlimited environment. 2. Learn to flawlessly execute a trading system. 3. Train your mind to think in probabilities. 4. Create a strong, unshakable belief in your consistency as a trader. Principles of consistency. 1. I objectively define my edges. 2. I predefine the risk of every trade. What will I lose? What is the probability of gain %? Entry and exit. 3. I completely accept the risk, or I am willing to let go of the trade and cut losses if wrong. 4. I act on my edges without hesitation or reservation. 5. I pay myself as the market makes money available to me. 6. I continually monitor my susceptibilities for making errors. 7. I understand the full principles for success and therefore I never violate them. Stay focused in the now. Opportunity of money flow. Every moment will truly be unique. Be objective and have unknown probabilities of price action. Only react to the flow. Have no commitment to any particular outcome of what will happen next. Just observe and react. Be confident in your abilities to appropriately respond to whatever does happen in the market. Don't trade your opinions, trade the action. Keep these principles with you when trading and go over them daily when you find yourself retaining away from any. Observe yourself and get back in line with self-discipline, refocus. Never stop studying and learning, staying in tune. This will help you produce consistent results. Identify choppy market and trending markets. Focus on growth and improvement. Evaluate your trading relative to the opportunity set. Do not become mentally disabled when a trade goes against you. If lose 40%, that may be a time to cut losses. Allowing it to go to zero is not smart. Best to save what can to be able to trade another day. Doesn't make sense to have anything to trade next. Better trade. Make a commitment to be disciplined and trade exactly to the rules before putting on a trade. Make sure you are in the right state of mindfulness, open to all outcomes and prepared to act on managing and taking profits when needed. Hedge both ways if unsure. Call and put. Trade the chart candlesticks, not what you think. If need, be patient and wait for confirmation. This will save you a lot of money and give you better entries for better returns. Pay attention to volume and levels. Do not revenge trade. Do not be reckless in trading. Have a plan and take profit at target. Stay focused on what you need to learn and have the willingness to adapt. Apply it. Remember to have stop-loss limits. Believe in your rules. Believe in your strategy. Realize the potential that will be presented to you. Trust yourself to cut your losses when in a losing trade. Remember, you still have the power to close the trade. If seem to have fear and FOMO, desperate to enter a losing trade, your mind may be playing tricks on you, causing you to see what's an illusion and is not there. Take a look at the chart, analyze the situation fundamentally and levels, then make the wise decision to enter the right side of the trade that will make sense at the time. Train your mind to handle mental stress like military. Common signs of greed. When ambition reaches a point where decision-making becomes compromised, that's greed. Greed ignores all risks to earning money without following proper risk management or following a trading system. When traders suffer from greed, they often think that things will go their way forever, are in fantasy land of an insane profit that you want to make, or even imagining what you'll do with the money when you make it. In short, you are not even assessing the setup. You are only focused on making money. Over the next 2 weeks, journal these things as the trading day progresses to capture where the underlying greed is at. Thoughts, emotions, behaviors, actions, changes to decisions, trading mistakes. Once you have finished, assign a number 1-10 to the severity in the greed through the previously mentioned greed factors, 10 being the highest. In order to resolve your greed, you need to determine what's the driving factor. Wake up and think in the moment. Do not be in a routine. Think, adapt to different changes in the market. Have a positive mindset. Be patient and wait for setups. There will always be another day to trade. The market never stops weekly. The question is, will you have money available to take the proper setup trade? When it presents itself, do not have fear when trading. Learn to trust the process. Learn how fear blinds you, not able to see the bigger picture, and then you can anticipate how fear will make other traders react. Must get over psychological damages from past trades that will generate fear. Open your mind up to being focused on what the markets are telling you. Be creative, have a strategic plan, and increase confidence to respond to the market with good execution in a timely manner. I have deep pride in following my plan and sticking to my strategic rules. Don't get entangled too much into the news. Trade the chart, not the news. Think positive affirmations. I will be on the right side of the trade. Before entering trade, know where your exit is. Get in, get up, and get out. Lock in profit. Remind yourself how much you can lose. Risk management. Eliminate and execute your losing trades immediately when low signs of reversal. Cut the trade out before it takes you out. To help to be fully aware and attentive to the market environment in the morning, we must get a good night's rest. Wake up, eat healthily, meditate, exercise, and have a positive, clear, and open mindset. Set a few high priority goals and work them hard. Each fear affects interpretations, feelings affects our emotions, and emotions affects our behavior. Even after winning trade, study the chart to see what you could have done better. If get big gap up or gap down, sometimes can use futures markets for reference of retest of support and resistance. Difficulties strengthen the mind. Master your trading mentality. Treat trading like any event in life. Don't go in with a losing attitude. Realize all market data is neutral. It's how you interpret for your results. Trading is all about putting the probability of a successful trade in your favor, understanding that the movement of all stocks is random. No one knows where a stock is going, if it's successful not during different streaks. Don't HODL 0-day SPX contracts at targets unless you sell some and YOLO a few to gamble. Once they lose momentum in the direction of your trend, they will lose value fast from theta decay, delta and dive crush from any pullback. The 3 development modes of trading. The mechanical stage. Rigid criteria define your edge. All execution decisions are made in advance of market activity. The market either conforms to the definition or not. Execute based on your plan. The subjective stage. This is a broader, more flexible mode of trading where you use everything you have learned about the nature of price movement to determine your edges. The intuitive stage. This is the most advanced mode of trading. It would be the equivalent of getting a black belt in martial arts. It is when you find yourself in the zone, tapped into the collective consciousness of the market. This gives you a sense of the flow. The professional trader is no longer susceptible to these typical trading errors because he has learned to think in probabilities. The benefit of thinking in probabilities becomes evident when you understand the relationship between how prices move and the mathematical formulas and price patterns that make up a trading methodology. This understanding helps you quantify that price movement into tradable edges. For risk management, do not focus on entry, focus on risk management. Calculated risk position size. I wait for the market to make its move, then attack the trend. Manage uncertainty. Have emotional discipline. The market has no structure, therefore you have to be your own structure. Implement and apply the rules as your trading guide to success. Accept responsibility. Pay attention to setup. Focus on trade. Stay constant with your rules. Risk and probabilities. Think of trading as a business that operates based on probabilities. The market is a random environment. Anything can happen at any moment. Probability and statistics. Understand the risk and probabilities involved and you'll have peaceful trading. 1. Trade only proper risk to reward trades. 2. Trade defensive. Look at chart. RSI oversold to overbought below VWAP going into close equals bearish, above VWAP going into close equals bullish. When in doubt, zoom out. Look far left for support back to pandemic levels. Look up Google Trends to see tickers' relevance to momentum. I will always cut losers quickly. Always have a plan before entering trade. Do not enter just because it's oversold or overbought. Know your entry and exit and execute as planned. Take profit at target, support or resistance. Small gains add up. Better to make 15% return than to lose 80% loss. Manage risk position size. Think, what are you thinking? How do you feel? Set stop loss. Take profit. Be patient. Have a plan. Follow plan. Know your system to grow your account. Even if you have high conviction in a stock, I believe it will go lower or more. Take profit at target or resistance level and make buyback at support and make your position size free. Let the remaining winner run to next resistance. Keep losses small. Let winners run. When trade is going against you with volume, stop being disabled and exit trade to save some money to trade another day. Better to have something rather than nothing. Learn how to lose properly. Close losing trade. I will never be able to accumulate and keep profits if I never get out of my losing trades. Do not let being stuck in a losing trades risk losing high earnings in a winning trader. If you find yourself in a losing trade with high volume to the opposite side, might be best to stop out at test of VWAP and save what you can. I.e., if you bought contracts at $4, they come down to $1 to 80 cents at VWAP, you should be able to sell for $2. Pay attention to volume on a downtrend or uptrend. If volume increases high on a downtrend followed by another high red volume, hold red candles on the 5 minutes until base out or hit key level. If get high volume, sell followed by high volume buy. Get sell limit order ready for the retest before the reversal. Same as on upside. If looking puts or calls at pre-market, ask myself, where is my hedge? Where will sellers be willing to buy and where will buyers be looking to sell? Overall bigger picture. Know your risk tolerance. Only risk what you are willing to lose. Why traders fail. 1. Spend time looking for a holy grail. 2. Trade without a proper plan. No risk management. 3. Do not focus on the psychological side to trading. 4. Do not treat trading like a job. 5. Rely on too many indicators. 6. Providing liquidity for smart money. Sell calls at targets. Hold puts in a bear downtrending environment. Follow the trend. Only high volume stocks. The trend is your friend. New catalyst changes weekly. Dollar cost average. Invest in good companies like Apple, Tesla, Microsoft, Google, Amazon. ETF SPY. QQQ long term. 5. Analyzing trades. Wait on confirmation on SPY daily chart. Wait for oversold or overbought on RSPN. Wait for wick green candle reversal to upside. GR strong green candle, not a red candle to go long. Vice versa on the short side. Wait for reversal. Trend candle on the day chart to go short. Swing. Pay attention to wicks on the weekly chart at support to the upside and resistance to the downside, i.e., engulfing candles. Be a comfortable protective risk taker. When Bitcoin and cryptocurrencies start to rally back up, it's considered a risk on environment. Stock equities will trend higher until the trend breaks for risk off. Pay attention to trade line MA break price action. When trade reverses sell position and switches direction, forming wicks at top resistance or wicks are bottom support for 5-point move. Remember to take profit at target. Watch for entry S of RSI oversold to overbought, vice versa. Think ahead of different scenarios that may happen, then you will be ready and know how to react. Then have predetermined entries or exits. Risk to reward ratio 1:3. Risk $1 to make 3. If SPY moves 1.5 points in your direction, take 1/3 profit. Take some risk off the table. If it goes another 1.5, take another half off and you can let the rest run risk free, but set stop loss at your last take profit limit. Sell stocks will either bounce, reject or break out. Watch previous day's low, high, and market low and high. Hedge your position for protection. Watch and pay attention to price and volume. If going up on low volume without momentum may be a rug pull incoming, remember X3 or X4. If no catalyst and you get 4 to 5 pints move on SPY, take profit before reverse or chop and theta decay premium burn. For example, enter contract at 3.25 and it hits your target, now trading at 12.25. Exit and take a profit. Important steps in trading method, where and why you enter and exit. Risk management, risk per trade and risk open position. Psychology, discipline to execute method. Give equal importance to each step. If sell off a lot and it comes back up to test VWAP, as soon as it touches VWAP sell, especially if out of the money. As soon as you see SPY starting to run towards VWAP, get your order ready to sell at touch. Identify setups before trade and monitor while in trade. Figure levels out so you already be ready to sell when they hit. Might only test one time with a 5-minute window before reversal. Has to be quick, sometimes like a robot. Ike the Algus. My problem is when in profit I don't sell because need more money, but the real fact is I have to take what the market is offering at the time before they take it all away and more. Make decisions based on careful thought rather than the feeling at the time or being too eager or anxious. Letting emotions get the best. Think before act to avoid mistakes. Are variables in our favor? News catalyst. High short interest elevated. RVOL holding above VWAP, consolidating above VWAP, breaks out of bullish wedge pattern. High of day. News catalyst. Pattern beaten down. Stock trim your position at target. If think will go more, use small sizes to make big profits. X 5 to 10% of the account. Only start with 1 or 2 contracts. If the trade goes against you, you can manage trade to get a bigger gain or make it a smaller loss. Remember to follow the rules. I lost everything and more because I was not patient and did not have the discipline to exit trades when I was supposed to, and I also had bad risk management by using too much entry size. Be patient and wait for proper setups. Focus on a plan. Have great discipline. Control emotions. Have realistic expectations. Be patient. Allow markets to come to you. Good analysis. Trade the chart. Trade what you see and not what you think. Levels. Certain price levels are more important than others. A level can retain its importance for months or even years. At support levels, there is more demand than supply. At resistance levels, there is more supply than demand. Resistance levels can convert into support levels. Support levels can convert into resistance levels. Options equals delta is the percent of odds that trade will go in that direction. Implied vitality is how nervous fear before earning IV will rise and after will fall. 4s on percent, not dollar sign. Be concerned with how much you can lose. Relax and stay focused. Have a thinking mindset. Pay attention to indicators. Be in the performance of the moment. Don't hold ZDT scalp for more than 5 to 15 minutes in the morning. If showing weakness, a scalp is a scalp. Take profit and enter at a lower strike price. 52-week high is bullish. When in doubt, zoom out and look at the SPY. Is the trend strong or weak on the weekly chart? Look 3 days to left after hours pre-market for support or resistance. Have price alerts set. Watch until the setup presents itself. Plus patience is key. Do not show any faith or hopium in stocks unless they show strength. If volume is too high and overbought and the next day of momentum dies and stock has lower vol, will tend to fall. If stock goes up high for 2 days, most likely will fall on the 3rd day. Take profit and re-enter at lower price. Know your risk management. Risk how much you are willing to lose. $. Only use 5% of cash value. Management. On the performance of the trade. A call is bullish? No. The price at a put is bearish? Which you enter skills are important and require paying attention, thinking, analyzing, problem solving. Remember, the seller of call or put is smart. Market makers are initially out to take your money. Choose premium wisely with insurance deep in the money. Higher delta or longer time 2 to 3 weeks out for safer bet. Less theta. Build an account up to sell puts on strong stocks. Tesla, Google, Apple. Watch out for fake news or early catalyst. Bullish strategy. Secure passive income. Put credit spread covered calls. Ticker has to have high vol, i.e. SPY. Sell a put option and purchase another put option at a lower strike price at same expiration. Less loss potential. Less profit but 80% gains. Safer, i.e. stock at $40 strike price, put price $80, $1.37, $85, $2.84 equals buy put $90, 5.09 sell put $95, 8. $10, 5.09 relieved 8.84 paid collected premium 2.25 relieved credit max profit 2.25 x 100 plus 255 per spread. If I sell the spread for 2.25 and it expires worthless $0, the gain per spread is $2.25. In this case time theta will be on your side like the market maker. 50 you will keep 100% of the premium. Max losses. Spread net credit 100x. This spread width is $5.40. 85 equals 5. Short put strike equals $90. Long put strike equals $85. Net credit equals $2.25. Break even $90. $2.25 equals 87.75. Look at change close on options to see how much percent the option has increased due to premium ODTE. 0-day last day options expire worthless. Most only write up its strong green candles on the 5 minutes. If it's choppy, get out of the stock. Is undecided, you can always re-enter when it makes its mind up. In options time is not on your side. 50 have no time to be wasted. Move on to a winning trade. If stock is oversold for 2 weeks, tends to rally back up. Overbought at resistance will fall back down, especially if not a value stock. When adding into a position, always make sure it's good confirmation. Be attentive and pay attention to chart. Have the courage to leap but be prepared to ride the waves and swim. Know the news, trade the chart. Choose your options strike price wisely. Pay attention to SPX premium prices into close. Most of the time they are overcharging on 0-day expiration options even until the last 10 minutes. For example, if SPX is trading at 4,108 into close and they are still charging $350 for that 4,110 call, technically that call is already worthless. Or if it's trading at 4,180 and it's trading at 4,100 and they are charging $240 for 4,100 call, technically that call is only worth $80 at that time. Mental clarity is an edge. European close is at 11:30. Power hour at 3 o'clock. Always check volume. If volume is over its normal volume, is good trade. Lower volume tends to be bearish. Next day lower LOL may fall. Look at 5 days for resistance and look at year for support. Use MMFI indicator tier trade in. Always start small, be patient, wait for the best setup, and when it comes tier in levels to mark, plot and know those levels. Pre-market high, pre-market low, previous day's high and previous day low. Any intraday big support resistance on the 5 minute. If we are above pre-market high, it is a high probability we will head higher. If we are above the pre-market high and yesterday's high, the momentum and trend is clearly up. Now we can use this method for pre-market low and yesterday's lows. Intraday support and resistance levels can act the same as above. Markets can remain irrational longer than you can remain solvent. The trend is your friend until the end of that trend. Improve your trading. 1. Understand market mechanics. 2. Stick to one strategy. 3. Learn yourself, personality, strengths and weaknesses, emotions. 4. Become more disciplined. 5. Journal plus review all your trades. 6. Less screen time is more mental game. 1. Need to have patience. Need to properly be able to read the market and the context clues it leaves us. 2. React to what the market presents us. Stop trying to predict. 3. Maintain proper risk management. Volatility means large price swings. Large price swings mean volatile emotions. We cannot let our emotions dictate our trading decisions. 4. More development equals more information equals more context equals easier to read equals better trading decisions. If you cannot properly read what's going on, do not trade the action. Need to have a valid trading thesis before the trade is put on. 5. Do not enter the market blindly. Do not trade the market solely because it's moving up or down. Trade when you get your entry confirmation signal. 6. Patience is key. Sometimes no trade is the best trade. Knowing when to take a trade is key. Analyzing and waiting for a proper setup is best for the best overall outcome. The market is always moving. It will be here tomorrow. It will be here next week. It will be here next year. The problem with that is, you might not be trading next week or next year if you don't focus on the process. If you don't focus on coming up with a plan and only trading that plan when your edge is present. Do not regret a trade that you did not take that went to the moon or was a good trade. Remember, the market is always in motion and there will always be another trade. Allow the market to come to you. There is no point in chasing the market. Change your perspective. Set up your alerts throughout your session and learn to respect that window of trading. If no trading opportunities develop, then simply don't look for any trades. Markets usually fall fast and rise slow. You must fall forward to get ahead. Trade in the money contracts or futures with time is safer to grow the account. Time in the market beats trying to time the market. Have realistic expectations as far as your learning journey or how long it will take you to reach consistency. Don't put a time on it. Simply focus on finding your edge and mastering the skill set, and the rest will follow. Surround yourself with successful mentors. Obviously, you can go the solo dolo route, but you will be saving so much of that time if you found the right guidance. Invest in some proper education. Your future self will thank you. You can make residual income in the markets by being consistent, following the rules and only taking the best setup. Develop a business plan. Trading is a business and should be treated accordingly. Build a plan around your methodology, the session you will trade, system you will use, confirmations, risk management, etc. In doing so, you will develop a professional environment for your craft and your trading business. Treating it in this manner will favor you in so many ways and you will see massive improvement. Everyone takes losses. Even if you're a seasoned trader, you're bound to take losses. It's a natural part of trading and it is inevitable. If you're managing your risk properly, trust me when I say you will start looking at your losses as small business expenses. Stay focused on mastering your trading rules and behavior to archive your goals and become a better trader. Trading is the opposite of normal human instinct nature. Do not have any emotions tied to trade. Have patience. Wait until setup presents itself. 7. Self-awareness. Practice self-awareness. Wake up. Be aware when trading. Be attentive in the moment. Be aware of your own awareness and mindset. Be mindful to identify if you are about to do something stupid. Ask questions. Analyze the full situation. Always remain disciplined, focused and confident with zero fear. Take emotion out of trading and just follow the plan. Take profits quickly and cut losers even quicker. Pay attention to the VIX for market volatility, the US dollar, bonds, and Bitcoin as a gauge for direction. Be aware of your emotions. Your state mind when you make a certain mistake. If you're doing it correctly, it will prevent you from repeating the same mistake. Observe your mistakes, and be aware of your feelings. Take screenshots of bad trades and review them. You do learn a lot from bad trades, specifically from reviewing them. Have a journal with lots of screenshots of bad trades as a constant reminder. Screen time, practice, and education will make you capable of finding good trades, but learning to avoid the bad trades will make you profitable. Trust the process over profits. Become a high-achieving student to the markets every day, willing and ready to learn. Take notes on lessons, review and record it into our conscious mind state to become a better trader daily. If I overtrade and be too attuned to trading every day, I may be hypnotized to take the wrong side of the trade. Market psychology. Remember, most news events are already priced in and the markets are mostly forward. Looking in my past, most trades have gone against me in the opposite direction soon after entering. Sometimes the logical, fundamentally best trade may be the wrong trade because most retail will be tricked into taking those positions only to lose all of their money. That's what market makers want, to drain profits back out of retail. Mostly therefore, sometimes but not all the time, the opposite trade of what your mind is telling you may be the best winning trade at that moment. When in doubt, zoom out to a higher time frame. Pay attention to key levels, price action and volume, and if still unsure, hedge your position by playing it both ways, both call and put. Take profit on winner at next support or resistance. Learn from losing trades. They have lessons to be remembered, but must not let emotions get involved. Must forget the emotion or trauma of past losing trades. The present and future have nothing to do with the past. The next trade may be the best trade you ever put on, but emotional stress will cause you to be fearful and not be able to take the winning trade. Must always be open-minded and have a clear open-minded mindset. Become in the moment and be able to read and interpret what the markets are telling you at the moment. Each moment in the market is painting the picture and making history. We must observe as the puzzle comes together to give us an edge. that will make sense to execute the winning trade we are destined for. Once you learn and instill these rules deep in your brain and be able to execute with confidence, you will then be able to extract as much money you want out of the markets over time. There is no limit to the amount you can make, but you must be disciplined enough to follow the rules and patient enough to wait for the proper setups and allow the follow-through to happen. Allow the trades to come to you and take you to your next stop, exit, and wait for next entry. These strategies will most likely play out to be profitable over time. Compound interest adds up. As my mother always says, Rome was not built in one day. Be patient and patience will pay yourself over time. Even 5% a day is 25% a week, which is over 100% of your money a month. Just imagine. We all know how easy it is to make 5 to 10% on an options contract. With the correct edge could be within 5 to 20 minutes. Just 100% of your money a month over 12 months would be 1,200% a year. Small gains add up over time. That's not even including the big winners that may come along within the year. Key takeaway is to be patient, stay disciplined, and always follow your rules. And most importantly, protect your capital by cutting losing trades quickly. Psychology 101. Sometimes it's not about learning more about the markets, but more so about learning more about yourself and how you react to price action and trade. Get your head in the game. Meditate and work out every day. Eat healthy foods and get a good night's rest. Risk and success go hand in hand. Investing means volatility. Lose a battle, win the war. Focus on your long-term strategy. Create a positive risk-reward profile. Mistakes are growth opportunities. Remember from your mistakes they are valuable lessons. Optimistic narratives are slow to grow, and pessimistic fall quickly. We are responsible for becoming a constantly profitable trader. Top secrets of successful traders. Risk-taking should be calm, collected, and calculated. Define your process. Absent of emotion, you will not profit on every trade. Your portfolio will grow with rational risk-taking over time. Compound interest is powerful. It adds up most of the time. I'm one day ahead of my predictions. The market will do big moves when people least expect it. Why do I keep going against the trend? Before I enter trade, ask myself, where will my hedge position be at? If we get a different reaction, we will see different results in the market. Trade in the now. Many traders are too focused on the past or the future and they forget about the present. All that should matter is what the market is telling you right now. Context, entries, exits, volume, effort, reward, etc. You create your own stress. The market does not. How to trade in the now. React to price volume as it occurs in the present moment, being mindful of your feelings, thoughts, and how they affect your ability to make proper trading decisions. When most people are bearish, markets will tend to go up when least expected. Accept the risk of taking trades. No trade will have guaranteed profits. Learn to break bad habits. Control your environment. 90% of trading success is an emotional game, not an intelligence game. You have to teach yourself how to analyze the market, how to manage risk, how to cut losses if you want to be a profitable trader. Qualities of successful traders: passion, persistence, self-discipline, a desire to improve, a commitment to learning in trading. Mastering our thoughts takes consistency and patience. Have a trading schedule. 2 -4 each day. You don't need to sit in front of the screen all day. There is enough money to be made trading only a few hours each day. Stop trying to squeeze every dollar out of the trading day when you have reached your profit target, or stop seeing setups. Stop trading. Fixing FOMO. Ask yourself one question before entering any trade. What is my risk to reward in this trade? If you cannot identify a good risk to reward, you should not take the trade. If you cannot determine a stop loss or profit target, you should not take the trade. Make the difference between a FOMO trade and a trade that maybe wasn't in your plan, but it's backed by your technicals. If you are concerned that price action is not clean, or that the volume is not enough, or that you don't have a confirmation, those concerns are not based on fear. Fear of entering. You see a good setup, you have confirmation, but you don't pull the trigger because of previous bad results. Disruptive fear. Your concern over another loss is based on a bad trading day. Your current trade idea has absolutely nothing to do with the outcome of a trade you took in the previous day. If you are reacting to your own concerns regarding profitability, you are acting in fear, and this will take you out of the current reality of the market. You will be acting based upon your own uncertainties and insecurities. Ask yourself, is it because of the price action, or is it because of your own insecurities? You'll need to be making your market decisions strictly on what the market is doing and showing you. This is the only way to be successful. If you are making your decisions on outside factors, like how badly you need the money, or what you need the money for, your judgment will be clouded and it will be much more difficult to see good opportunities to profit. Finding your zone. You deal with losses and failures every day. No setup is perfect and every setup is unique. Even winning days are full of small mistakes. Your new comfort zone as a perfectionist. You're used to think inside the box rather than outside of it. But as a trader, feeling uncomfortable is your new comfort zone. Traders do not decide their success. They decide their habits and their habits decide their success. Your bad trading habits might have been fun in the past, but now they just hold you back. They cost you money and make you emotional during trading. The longer you wait to fix your bad trading habits, the longer you will wait to be a profitable trader. As a trader, you will not win every trade. Traders spend more time waiting than trading. Traders are the most successful entrepreneurs out there. As traders, we are able to turn what excites us into profit. That is the core value of a successful entrepreneur. In the trading, you either adapt or the market will eat you alive. Don't be fooled by the pops or drops. Take profit on out-of-the-money contracts ASAP when the target hits fast from being down to in. Profit contract premium will be elevated from the momentum in that direction, but as soon as it loses momentum the premium will decay and lose value fast and drop if the momentum does not continue in that direction. Accept the loss on losing trades, and close losing trades before the loss gets bigger. Have a tight stop loss on choppy days. Scalp in and out. Important notes. Do not quit your job yet. If you've made it this far, you probably wouldn't do that anyways, but still, do not be discouraged. There will constantly be setbacks and new challenges. You should have an endless supply of motivation because even though trading is incredibly difficult, there is nothing more rewarding. 8. Trade strategy. The two ways to trade: discretionary versus systematic. Both valid. Systematic traders create rules and only take trades when the market conditions meet a set of criteria. Possible but difficult, because you are searching for a combination of information that yields consistently profitable results in a market where price movements are the results of thousands of participants, all with different motives and position sizes. This is why most traders use a combination of rules plus discretion. Discretionary traders are not waiting for specific setups or rules to be met. The trades they take vary and can be different every day. Are trading on intuition, a feeling, which is developed through implicit memory and experience, can't be learned from a book, video, etc. Watching them trade will mostly just look like guessing because we have no idea what pattern or event happened to cause them to take a trade. Plus plot mark lines on previous day's top and bottom of the body on day chart for next day support or resistance zones in the morning. If the first 15 minutes only wicks to prior day house, the stock is weak. If the body closed above or inside of the previous day low, may continue. Pay attention to wick candles or full body candles for strength at support or resistance for reversal with volume. If in a wick candle, exit trade, i.e. in strong body candle, watch for follow through. Sometimes support or resistance may be only tested once. Scalp 15 to 30 minutes tops and take profit at levels. Avoid the chop, theta decay, fake out, sell at morning pop, buy back at the drop. Most out of the money odd options will expire worthless. CE5. T conditions. Entry stop target. Check MMFI stocks above 50-day moving average on bar chart. Have a disciplined plan for trade, with no emotional attachment of past trades. Where you have a high unusual pop, sell quickly as everyone else will be selling. In this market, you only get paid from opportunity, not time. For proper setup opportunities to take advantage of a good risk to reward trade, be a sniper. If a weak stock breaks below SMA and support Fibonacci level, it may not go back up. Only play momentum stocks. Once stock loses momentum, it will go down or it will consolidate until its next leg up or down. Puts are guaranteed a profit in a bear market. When a stock takes a big fall, most likely will fall for a few more days for institutions to get out. Most of the time will pop up due to shorts covering, but only for a dead cat bounce. No position is or will be perfect in the stock market. Good enough. 1S good enough. Take the highest probability setups and take profit at targets as planned. Buy options when IV implied volatility is low. Sell options premium when IV is low. The market has to be liquid or you may not be able to sell if no vol buyers. 1. Trade small positions. 2. With a high probability of success. 3. In liquid stocks and options. 4. Using the right strategy. 5. As many times as you can spy. At low of day may come back to test VWAP and may fail in bear market. Sell 75% and hold one contract to come back to break even. Sell ASAP. If in a swing trade, take profit in the morning first 15 minutes after bell to 30 minutes, then re-enter on pullback or sell most contracts, then average down. If entering a new trade at new highs, wait for the direction of the chart. Key levels of support: high resistance of the momentum for that day has to be trending with volume catalyst to take trade. Sell ODTE out of the money early on a Friday if they go green. On a bullish sentiment, straight gas cash open, wait for pullback to the pre-market low to go long and ride the trend up until wicking red candles at overbought RSI, take profit into resistance. After quad witching options expirations, markets will go into a new cycle plus gamma long options markets profit liquidity, gamma short take liquidity. Net long not volatile, gamma volatile. VIX usually sells off after hitting 30 inverse 1 SPY will retrace back up. If vol is greater than open interest, more contracts have been created and opened. Look at time and sales to find out if calls or puts opened or closed. Look at option chain calls and puts open interest to see an expected move of market. More calls could react as long gamma squeeze. Read the take bid and ask. Buyers and sellers, supply a demand, time and sales. Dissect the trades. Do not be stuck on one trade all day and miss better opportunities. Take profit at targets. Hawkish equals bearish, dove equals bullish. When get a high volume bar on the day, big red or green bar on day chart, you can swing positions for 2 to 3 days on momentum, gap up or gap down. Get exposure to upside call at low of day pre market with high volume cash buy at open. Watch for retest stop out below low of day or vice versa to downside put with high volume sell wicking at high of day, stop out above high of day. Use 15 minutes chart for more clarity intraday. Especially on Webull, 5 minutes will not show levels until approached. Use stochastic RSI indicator for signs only. Look at pre-market for the upside in a bull market, not a bearish market. Watch for big high volume red or green pin bars for reversal entry on a big gap up or big gap down. If I am more bearish or bullish, expecting the gap to fill, it may not. They don't always fill. Play both ways, 50% call and 50% puts. Take profit on win or sell other at VWAP test. Directional bias. Directional bias is a way to stay on the winning side of the trade by not going against the sentiment. Look at the daily candle color, red on day or green on day, and also above or below VWAP, more likely to long, buy, a green on the day, above the VWAP setup, and short sell a red on the day, lower than VWAP setup, gap and go or gap and crap, hack, at 10 minutes rigged, have buy 2. Open limit orders set for both calls and puts closest to at the money for 25 cents to 50 cents, around $300 to $500 worth each for both, or on the same day SPY QQQ have it set to buy contracts at 10 cents or even better 5 cents. Use 1 minute chart for quick scalps in and out with high conviction cryptocurrency like Bitcoin and Ethereum. It would be best to dollar cost average in them weekly and hold as a long term investment. They are volatile in these markets whenever they hit a support area like Bitcoin. As of now, support is around 17,500. Buy more, and if they crash, buy even more. Same as us markets. SPY a yearly low of 362. Buy more. QQQ at 268. Buy more. Over time they will go back up. Only deploy funds that you will not need on a day-to-day basis for essentials, needs, and bills. Most assets, commodities, stocks and securities are considered to be trading at a lower price right now as of Sept 2022, but they are mostly still overvalued, trading at a multiple higher than their actual earnings. Since the COVID pandemic, the Fed had to pump money into the economy QE in order to save the economy, but they printed too much liquidity, which had caused all of the markets, including stocks, cryptocurrencies, commodities, and the housing market, to become overvalued and in a bubble. This also caused inflation to rise. They have retraced a bit since the highs. Many economists are bearish, saying they will go lower, and many are bullish, stating they will go higher sooner. But no one really knows. All we can do is trade the chart and react to the trending price action at the time. Read and study these rules. Remember, these rules. Follow the rules. If have to read every morning, do so. These are notes from over time of my experience trading. Not every strategy will work every time. Every day will be different, but they do have the advantage to give your trading an edge. Must determine when the appropriate time is to apply them and profit. It has to make sense. I hope this book will help save many traders money and can be of assistance in gaining profits, so everyone will be able to achieve their dreams and goals and finally be able to build generational wealth and cop their win Lambas, yachts, mansions and penthouses. Always remain motivated, humble and dedicated to becoming the best trader you are destined to be. Let's get it and make it happen. Think positive affirmations into existence. 9. Law of propensity. Don't focus on the money, focus on what do I need to learn and how can I adjust my mind to trade the markets properly. Marginal propensity to save. MPS is an economic measure of how savings change, given a change in income. It is calculated by simply dividing the change in savings by the change in income. A larger MPS indicates that small changes in income lead to large changes in savings. Strategy. Risk management. Bring the mind to the moment of trading. Trading psychology. Be patient, there will always be another trade. Your mind is a magnet, you are your thoughts. Think positive thoughts, good things tend to happen. Think negative things, bad things tend to happen. Best to always cultivate good positive thoughts with a clear thinking mindset. Important traits of a good trader. Passion for the financial markets and trading. Established capability for systematic problem solving. Technical skills. Acute understanding of risk taking in uncertain conditions. Programming languages. Algorithm theory and statistics. Strategic decision-making skills. Strong ability to take in new information and act quickly. Resilience. The desire to take ownership. Commitment to working with integrity, and ability to overcome obstacles to achieve long-term goals. Intellectual curiosity and a motivation to learn. Identify pricing inefficiencies and collaborate with traders to monetize predictions. Identify new sources of data and transform unstructured data sets into signals. Own the information space you work within, i.e. large cap tech. By monitoring trends in the marketplace, employ a holistic approach to predicting the distribution of outcomes and making volatility predictions. Ability to think about the world systematically and quantitatively, as well as the ability to deal with uncertainty in a logical and consistent approach. How to attract 1. Calm our nervous system. 2. Ask your soul what it truly wants. 3. Focus on your intention. Be specific. 4. Imagine the feeling of it happening. 5. Let go of expectations. 6. Dwell in gratitude. What do you desire? Have certainty and clear intention about your desire. Clarity is key. Breathe in and affirm, I accept and I am worthy of all I desire. Imagine how attaining that desire will bring happiness to you and those you love until you find excitement and positive emotion. Once found, inhale deeply and lock the feeling into every part of our body. Only take action on things that relate to an excite positive emotion to your desire. You must learn to follow your plan by trading the chart and executing when your signals trigger, without hesitation. It's an exercise. That is the only result you should be looking for. It doesn't matter if the trade was good or bad. Flawless execution does not mean you bought at the lowest price and sold at the highest. 99% of the time you will never buy the bottom and sell the top. You don't need to do that to make good money trading. Flawless execution to me means you perceive opportunity and you act upon it without thinking. Flawless execution equals trade the chart plus follow the plan. Terrible execution equals emotions. Do the trading. Trying to extract money from the markets fast is usually a setup for failure and is the wrong approach, but with time and patience smaller gains in the market tend to be a key for success. Discipline refers to rule following behavior, to regulation, order, control, and authority. It may also refer to punishment. Discipline is used to create habits, routines, and automatic mechanisms such as blind obedience. It may be inflicted on others or on oneself. Self-discipline refers to the practice of self-restraint, controlling one's emotions, and ignoring impulses. What is the law of supply and demand? The law of supply and demand combines two fundamental economic principles describing how changes in the price of a resource, commodity, or product affect its supply and demand. As the price increases, supply rises while demand declines. Conversely, as the price drops, supply constricts while demand grows. Levels of supply and demand for varying prices can be plotted on a graph as curves. The intersection of these curves marks the equilibrium, or market clearing price at which demand equals supply, and represents the process of price discovery in the marketplace. Trading skills. Components of consistency. Develop the ability to recognize if you have crossed the threshold from normal self-confidence into a state of euphoria. Learning to trade without fear, hesitation or internal conflict is a function of believing that you don't have to know what is going to happen next on a trade-by-trade basis to win or make consistent money. How to think like a professional. Thinking, assuming or believing you know what will happen next creates an unrealistic expectation in a specific outcome. Typical trading errors that the professional has evolved beyond. Don't define the risk in advance of putting on a trade. Define the risk, but don't take the loss and it turns into a bigger loss. What characteristics distinguish the pro from the typical trader? Professionals plan their trades They execute their plan without error. They can move in and out of their trades with an ease and effortlessness that would boggle the mind of the typical trader. What characteristics distinguish the pro from the typical trader? Professionals plan their trades. They execute their plan without error. They can move in and out of their trades with an ease and effortlessness that would boggle the mind of the typical trader. Components of consistency: have a trading plan on how to utilize the edge. Risk parameters: money management, position size, profit objectives. Unrealistic expectations cause us to define, interpret, and therefore perceive market information as threatening. Being wrong: losing, missing out, leaving money on the table. Typical trading errors that the professional has evolved beyond. Don't define the risk in advance of putting on a trade. Define the risk, but don't take the loss and it turns into a bigger loss. Let a winning trade turn into a loser without having taken any profits. Move a stop closer to an entry point, get stopped out, and the market trades back in your favor. Why futures are the good to trade? No Pacific Daylight Time rule. Options and stocks require $25,000 to do more than 3-day trades in a 5-day period. Trade with just a couple $100. Superior trading platform. 60/40 tax rule. Massive. Choose your exposure. MNQ is $2 per point, or you could trade 10 plus contracts on NQ at $200 plus per point. LOL. High liquidity, easily get in and out of positions. Very small spreads, flexible hours. Trading almost 24/6. Trade settle instantly. 10. Definitions: bullish, also known as dovish, also known as a bull, believes that the price of one or more securities or indexes will rise. This can apply at any scale of the market. Sometimes a bullish investor believes that the market as a whole is due to go up, foreseeing general gains. Bearish, also known as hawkish. Being bearish in trading means you believe that a market, asset, or financial instrument is going to experience a downward trajectory. Being bearish is the opposite of being bullish. Sentiment, attitude, thought, or judgment prompted by feeling. Predilection, a specific view or notion. Opinion, emotion, refined feeling. Short squeeze. A short squeeze is an unusual condition that triggers rapidly rising prices in a stock or other tradable security. For a short squeeze to occur, the security must have an unusual degree of short sellers holding positions in it. The short squeeze begins when the price jumps higher unexpectedly. The condition plays out as a significant measure of the short sellers coincidentally deciding to cut losses and exit their positions. Pump and dump, a form of securities fraud that involves artificially inflating the price of an owned stock through false and misleading positive statements, in order to sell the cheaply purchased stock at a higher price. Rug pull FUD, fear, uncertainty and doubt, usually evoked intentionally in order to put a competitor at a disadvantage. FOMO, the fear of missing out. FOMO is an emotional response to the belief that other people are living better, more satisfying lives, or that important opportunity are being missed. FOMO often leads to feelings of unease, dissatisfaction, depression, and stress. Buy. This means buying shares or taking a position in a company. Sell. Getting rid of the shares as you have achieved your goal or want to cut down losses. Ask. Ask is what people who are looking to sell their stocks are looking to get for their shares. Bid. Bid is what you are willing to pay for a stock. Ask. Bid. Spread. Spread is the difference between what people want to spend and what people want to get. Bull. A bull market is a market condition where investors are expecting prices to rise. Bear. A bear market is a market condition where investors are expecting prices to fall. Limit order. A limit order is a type of order which executes at the price placed for buy or sell. Market order. A market order is a type of order which executes as quickly as possible at the market price. Day order. A day order is a direction to a broker to execute a trade at a specific price that expires at the end of the trading day if it is not complicated. Volatility. This means how fast a stock moves up or down. Going long. Betting on the stock price will increase so that you can buy low and sell high. Averaging down. This is when an investor buys as the stock goes down so as to increase the price at which purchased. Capitalization. This is what the market thinks a company's value is. Float. This is the number of shares that can be actually traded after deducting the shares held by insiders. Authorized shares. This is the total number of shares that a company can trade. IPO. It is an initial public offering that happens when the private company becomes a publicly traded company. Secondary offering. This is another offering in order to sell more stocks and to raise more money from the public. Dividend. A portion of the company's earnings that is paid to the shareholders. Broker. A broker is a person who buys or sells stocks on your behalf. Exchange. An exchange is a place where different types of investments are traded. Portfolio. A collection of investments owned by you. Margin. A margin account lets a person borrow money from the broker to buy shares. Sector. A group of stocks in the same sector. Stock ticker symbol. A 1 to 3 character alphabet root symbol which represents a company listed on the exchange. Stock split. A stock split happens when a company increases the number of its shares to boost the stock's liquidity. Although the number of shares outstanding increases by a specific multiple, the total dollar value of all shares outstanding remains the same because a split does not fundamentally change the company's value. The most common split ratios are 2-for-1 or 3-for-1, sometimes denoted as 2-1 or 3-1. This means for every share held before the split, each stockholder will have 2 or 3 shares, respectively, after the split. Types of technical indicators. There are 4 main types of technical indicators: trend following, oscillators, volatility, and support resistance. They are grouped based on their function, which ranges from revealing the average price of a currency pair over time to providing a clearer picture of support and resistance levels. List of technical indicators. Trend indicators. Trend following indicators were created to help traders trade currency pairs that are trending up or trending down. We have all heard the phrase "the trend is your friend." These indicators can help point out the direction of the trend and can tell us if a trend actually is valid to exist. Moving average MA. The MA or simple moving average SMA is an indicator used to identify the direction of a current price trend, without the interference of shorter-term price spikes. The MA indicator combines the price points of a financial instrument over a specified time frame and divides it by the number of data points to present a single trend line. The data used depends on the length of the MA. For example, a 200-day MA requires 200 days of data. By using the MA indicator, you can study levels of support and resistance and see previous price action, the history of the market. This means you can also determine possible future patterns. Technical tool that averages a currency pair's price over a period of time. The smoothing effect this has on the chart helps give a clearer indication on what direction the pair is moving, either up, down, or sideways. There are a variety of moving averages to choose from, with simple moving averages and exponential moving averages being the most popular. Exponential moving average EMA. EMA is another form of moving average. Unlike the SMA, it places a greater weight on recent data points, making data more responsive to new information. When used with other indicators, EMAs can help traders confirm significant market moves and gauge their legitimacy. The most popular exponential moving averages are 12 and 26-day EMAs for short-term averages, whereas the 50 and 200-day EMAs are used as long-term trend indicators. Stochastic oscillator. A stochastic oscillator is an indicator that compares a specific closing price of an asset to a range of its prices over time, showing momentum and trend strength. It uses a scale of 0 to 100. A reading below 20 generally represents an oversold market and a reading above 80 an overbought market. However, if a strong trend is present, a correction or rally will not necessarily ensue. Moving average. Convergence. Divergence. MACD. MACD is an indicator that detects changes in momentum by comparing 2 moving averages. It can help traders identify possible buy and sell opportunities around support and resistance levels. Convergence means that 2 moving averages are coming together, while divergence means that they are moving away from each other. If moving averages are converging, it means momentum is decreasing, whereas if the moving averages are diverging, momentum is increasing. The moving average convergence-divergence tracks the difference between 2 EMA lines, the 12 EMA and 26 EMA. The difference between the 2 EMAs is then drawn on a subchart, called the MACD line, with a 9 EMA drawn directly on top of it, called the signal line. Traders then look to buy when the MACD line crosses above the signal line and look to sell when the MACD line crosses below the signal line as seen here. There are also opportunities to trade divergence between the MACD and price. A Bollinger Band is an indicator that provides a range within which the price of an asset typically trades. The width of the band increases and decreases to reflect recent volatility. The closer the bands are to each other, or the narrower they are, the lower the perceived volatility of the financial instrument. The wider the bands, the higher the perceived volatility. Bollinger Bands are useful for recognizing when an asset is trading outside of its usual levels and are used mostly as a method to predict long-term price movements. When a price continually moves outside the upper parameters of the band, it could be overbought, and when it moves below the lower band, it could be oversold. Relative Strength Index RSI. RSI is mostly used to help traders identify momentum, market conditions and warning signals for dangerous price movements. RSI is expressed as a figure between 0 and 100. An asset around the 70 levels is often considered overbought, while an asset at or near 30 is often considered oversold. An overbought signal suggests that short-term gains may be reaching a point of maturity and assets may be in for a price correction. In contrast, an oversold signal could mean that short-term declines are reaching maturity and assets may be in for a rally. The Relative Strength Index is arguably the most popular oscillator to use. A big component of its formula is the ratio between the average gain and average loss over the last 14 periods. The RSI is bound between 0-100 and is considered overbought above 70 and oversold when below 30. Traders generally look to sell when 70 is crossed from above and look to buy when 30 is crossed from below. Fibonacci retracement. Fibonacci retracement is an indicator that can pinpoint the degree to which a market will move against its current trend. A retracement is when the market experiences a temporary dip. It is also known as a pullback. Traders who think the market is about to make a move often use Fibonacci retracement to confirm this. This is because it helps to identify possible levels of support and resistance, which could indicate an upward or downward trend. Because traders can identify levels of support and resistance with this indicator, it can help them decide where to apply stops and limits, or when to open and close their positions. Ichimoku cloud. The Ichimoku cloud, like many other technical indicators, identifies support and resistance levels. However, it also estimates price momentum and provides traders with signals to help them with their decision making. The translation of Ichimoku is one-look equilibrium chart, which is exactly why this indicator is used by traders who need a lot of information from one chart. In a nutshell, it identifies market trends, shows current support and resistance levels, and also forecasts future levels. Standard deviation. Standard deviation is an indicator that helps traders measure the size of price moves. Consequently, they can identify how likely volatility is to affect the price in the future. It cannot predict whether the price will go up or down, only that it will be affected by volatility. Standard deviation compares current price movements to historical price movements. Many traders believe that big price moves follow small price moves, and small price moves follow big price moves. Average Directional Index ADX. The ADX illustrates the strength of a price trend. It works on a scale of 0 to 100, where a reading of more than 25 is considered a strong trend, and a number below 25 is considered a drift. Traders can use this information to gather whether an upward or downward trend is likely to continue. ADX is normally based on a moving average of the price range over 14 days, depending on the frequency that traders prefer. Note that ADX never shows how a price trend might develop. It simply indicates the strength of the trend. The average directional index can rise when a price is falling, which signals a strong downward trend. ADX indicator. The average direction index won't tell you whether price is trending up or down, but it will tell you if price is trending or is ranging. This makes it the perfect filter for either a range or trend strategy by making sure you are trading based on current market conditions. Oscillator indicators. Oscillators give traders an idea of how momentum is developing on a specific currency pair. When the price tracks higher, oscillators will move higher. When the price drops lower, oscillators will move lower. Whenever oscillators reach an extreme level, it might be time to look for a price to turn back around to the mean. However, just because an oscillator reaches overbought or oversold levels doesn't mean we should try to call a top or a bottom. Oscillators can stay at extreme levels for a long time, so we need to wait for a valid sign before trading. Stochastics indicator. Stochastics offer traders a different approach to calculating price oscillations by tracking how far the current price is from the lowest low of the last X number of periods. This distance is then divided by the difference between the high and low prices during the same number of periods. The line created, %K, is then used to create a moving average, %D, that is placed directly on top of the %K. CCI indicator. The commodity channel index is different from many oscillators in that there is no limit to how high or how low it can go. It uses 0 as a centerline with overbought and oversold levels starting at +100 and -100. Traders look to sell breaks below +100 and buy breaks above 100. Volatility indicators. Volatility measures how large the upswings and downswings are for a particular currency pair. When a currency's price fluctuates wildly up and down, it is said to have high volatility. Whereas a currency pair that does not fluctuate as much is said to have low volatility. It's important to note how volatile a currency pair is before opening a trade, so we can take that into consideration with picking our trade size and stop and limit levels. Bollinger Bands indicator. Bollinger Bands print 3 lines directly on top of the price chart. The middle band is a 20-period simple moving average with an upper and low band that is drawn 2 standard deviations above and below the 20 MA. This means the more volatile the pair is, the wider the outer bands will become, giving the Bollinger Bands registered sign the ability to be used universally across currency pairs no matter how they behave. ATR indicator. The average true range tells us the average distance between the high and low prices over the last set number of bars, typically 14. This indicator is presented in pips where the higher the ATR gets, the more volatile the pair is, and vice versa. This makes it a perfect tool to measure volatility. Support resistance indicators. Support and resistance are key to technical analysis. The concept refers to the price levels on charts that form barriers to an asset price being pushed in a given direction. Pivot points. Pivot points are one of the most widely used in all markets including equities, commodities, and forex. They are created using a formula composed of high, low, and close prices for the previous period. Traders use these lines as potential support and resistance levels, levels that the price might have a difficult time breaking through. Donchian channels. Price channels or Donchian channels are lines above and below recent price action that show the high and low prices over an extended period of time. These lines can then act as support or resistance if price comes into contact with them again. For a deeper look at using this tool successfully, what you need to know before using trading indicators. The first rule of using trading indicators is that you should never use an indicator in isolation or use too many indicators at once. Focus on a few that you think are best suited to what you're trying to achieve. You should also use technical indicators alongside your own assessment of the movements of an asset's price over time. The price action. It's important to remember that you have to confirm a signal in some way. If you're getting a buy signal from an indicator and a sell signal from the price action, you need to use different indicators, or different time frames until your signals are confirmed. Another thing to keep in mind is that you must never lose sight of your trading plan. Your rules for trading should always be implemented when using indicators. Technical indicators. A summary. Each of the technical indicators above can help you to advance your technical analysis and better understand price action. But it's important to remember not to get bogged down and to choose only the indicators that work for you. Overly complicating your approach with too many indicators can force traders to process too much information, resulting in paralysis by analysis. As a result, it's best to keep it simple and only use a handful in accordance with the goals set out in your trading plan. Inflation. Inflation is a rise in prices, which can be translated as the decline of purchasing power over time. The rate at which purchasing power drops can be reflected in the average price increase of a basket of selected goods and services over some period of time. The rise in prices, which is often expressed as a percentage, means that a unit of currency effectively buys less than it did in prior periods. Inflation can be contrasted with deflation, which occurs when prices decline and purchasing power increases. What is stagflation? Stagflation is an economic cycle characterized by slow growth and a high unemployment rate accompanied by inflation. Economic policymakers find this combination particularly difficult to handle, as attempting to correct one of the factors can exacerbate another. Consumer Price Index (CPI). The Consumer Price Index (CPI) measures the monthly change in prices paid by U.S. consumers. Producer Price Index (PPI) measures the average change over time in the prices domestic producers receive for their output. It is a measure of inflation at the wholesale level that is compiled from thousands of indexes measuring producer prices by industry and product category. What is personal consumption expenditures? PCE. Personal consumption expenditures, PCE, also known as consumer spending, is a measure of the spending on goods and services by people of the United States. FOMC meeting refers to the 12 members of the FOMC who meet 8 times a year to discuss monetary policy. During the FOMC meeting, members discuss developments in the local and global financial markets, as well as economic and financial forecasts. What are the FOMC minutes? The FOMC meeting minutes provide a detailed summary of the FOMC discussion and inform the public and Congress about the full range of policymakers' views and debates about monetary policy issues, including the diversity of views. What is the Beige Book? The Beige Book is a report produced and published by the Federal Reserve. The report, referred to formally as the Summary of Commentary on Current Economic Conditions, is a qualitative review of economic conditions. The Beige Book is published 8 times each year before meetings held by the Federal Open Market Committee, FOMC, and is considered one of the most valuable tools at the committee's disposal for making key decisions about the economy. Quantitative easing QE is a monetary policy whereby the central bank purchases predetermined amounts of government bonds or other financial assets, e.g., municipal bonds, corporate bonds, stocks, etc., in order to inject money into the economy to expand economic activity. Quantitative easing is an unconventional form of monetary policy. What is quantitative tightening QT? Quantitative tightening QT refers to monetary policies that contract, or reduce, the Federal Reserve System, Fed, balance sheet. This process is also known as balance sheet normalization. In other words, the Fed, or any central bank, shrinks its monetary reserves by either selling treasuries, government bonds, or letting them mature and removing them from its cash balances. This removes liquidity, or money, from financial markets. It is the opposite of quantitative easing QE, a term that has become ingrained in the financial markets vernacular since the 2008 financial crisis, which refers to monetary policies adopted by the Fed that expand its balance sheet. What are jobless claims? Jobless claims are a statistic reported weekly by the U.S. Department of Labor that counts people filing to receive unemployment insurance benefits. There are 2 categories of jobless claims: initial, which comprises people filing for the first time, and continuing, which consists of unemployed people who have already been receiving unemployment benefits. Jobless claims are an important leading indicator of the state of the employment situation and the health of the economy. Jerome Powell is the head member of the Fed. When he speaks, the market moves and reacts. Mark your calendars and be aware of these economic reports. Company earnings and news to come out all can and will move markets. Conclusion: read and study these rules. Remember these rules. Follow the rules. If have to read every morning, do so. These are notes from over time of my experience trading. Not every strategy will work every time. Every day will be different, but they do have the advantage to give your trading an edge. Must determine when the appropriate time is to apply them and profit. It has to make sense. I hope this book will help save many traders money and can be of assistance in gaining profits so everyone will be able to achieve their dreams and goals and finally be able to build generational wealth and cop their when Lambos, yachts, mansions, and penthouses. Always remain motivated, humble and dedicated to becoming the best trader you are destined to be. Let's get it and make it happen. Think positive affirmations into existence. As my long-lost friend used to say, IT's time RIP. Trent White Aka Bankroll Fresh. IG, @AJSTR8 Cash Twitter, @OneFlyI Hustle.